Do you ever look at a stock and wonder, should I buy the stock? Is it a good price or not? Well, I'm going to show you how to value a stock using a discounted cash flow model. And you're going to want to watch the entire video because there's going to be tons of pop-ups with graphs, charts, and more information to help you really understand how to value a company like I'm going to do right now. The company we're going to look at is The Trade Desk. And what they do is develop software that's used for marketing purposes. So let's get started with the model. So first we're going to need the market cap, which is $17.135 billion. It's a pretty good sized company. And then the stock price of $372.03. And that means they have 46 million shares outstanding because you take the market cap divided by stock price, that gives you the shares outstanding. Next we need the free cash flow, and this is the lifeblood of any company. It's the cash that's left over after operating a business. So you'd want to invest in a company with positive, healthy, free cash flow. And if it's a negative, make sure they're investing in quality things because you want to see a return on those investments. Next, let's get their net income, which is the profit and loss on the income statement. And we take 4 years of data for each. And then last is revenue. So to do a discounted cash flow model, you just estimate the future free cash flows and you discount that number back to today's dollar amount. And that's where you find the value of the entire company. And when you divide that by 46 million shares, that gives you the intrinsic stock price. So it looks like the numbers are fairly consistent and positive, which is important. And their revenue has tripled from 2016 to 2019. That's a really good sign. Now this company has no debt, which is a great sign. Next we need the beta so we can find out the cost of their equity. That's a really high beta, 2.62. That means the stock moves more than 2.5 times the market. Usually you don't want a stock that is so volatile because that requires a larger weighted average cost of capital. So their WACC is 22.44%. And we figure that out by using the capital asset pricing model. So I estimated their future free cash flows for 4 years, and then I did a terminal value, which is all years past year 4. I discounted those numbers back to today using the weighted average cost of capital, and then the value of the company is $5 billion. And when you divide that by 46 million shares, we get an intrinsic stock price of $110. So it's trading at a 240% premium. It's trading at $372. So according to the financials, it's definitely a sell. It looks like the stock has been really bid up because of people's perception of this company's future. It was trading around $100 a couple of years ago. Let's look at Simply Wall Street and see what they estimate the stock to be. So the Trade Desk, they're estimating at 160. That's their fair value of the stock. So they use different assumptions than I use. I actually don't know what their assumptions are. But 160, it also implies it's trading at a significant premium. And this can easily happen. You can see stocks that are losing money that are worth nothing according to their financials, but their stock price is obviously worth more than nothing. It can't be worth nothing unless it goes bankrupt. So if people think the future of a company is really strong, they're going to buy the stock and the price will go higher and higher, even if the company does not report positive financials. And there's 3 main ways to identify the value of a company. There's what we call indicators. There's the fundamental factors, which is what we looked at, the earnings. And there's also technical factors. And market sentiment has the strongest influence on this stock because it's obviously trading way outside its intrinsic value. So it's up to you. Do you think the stock is really worth $370? If you do, you may want to buy it. But if you think it's worth $110, you may want to wait till the price comes down. And the only way to really mitigate these types of things is to hold the stock long term and wait out the ups and downs. So let's look at their current assets. We'll go to the balance sheet, and that's back in the financial section. And current assets is cash, accounts receivable, and inventory. So their current assets is $1.5 billion. Let's get their current liabilities. Those are payables and debts due within 12 months. They don't have any debts. It's all payables, and they have accrued liabilities as well. So the current liabilities is $930 million. And now the equity, that's the total assets minus total liabilities. Stockholders' equity, $612 million. And the EBIT, earnings before interest and taxes, that's operating income. That's the income they make after operating their business each year. That's $112 million. This is an important number. They also have to reduce taxes and interest payments from that number. But in their case, they don't have any interest payments because they have no debt. So let's look at their ratios. Wow, 158 PE. This doesn't mean they're a terrible company. It just means they're probably investing a lot of money into growing their business. Price of sales is really high as well. I like to see on the 2.2 they have 25. They have a really high price to book at 28. They have a good current ratio of 1.6. So this implies they have enough cash from their everyday business to fund their current liabilities. So that's why they don't need to go into debt, because they're generating enough cash. And they're probably using a lot of that cash to grow their business, which is why they have such high ratios. ROE is okay. It's 18%. I like to see 20%. So it's not surprising their ratios are weak because they're trading at a significant premium. This is a type of company that people invest in for the future. I invest in companies for what they proved to me in the past. If you haven't proved that you're profitable, then I'm not interested in investing in your company. Just like if a friend came up to you and said, I'm losing $100,000 a year in my business, can you give me $50,000 to invest in my business? You would say, why would I do that? They say, because the future, I'm going to be really profitable in the future. You would roll your eyes and walk away. Same thing with a company. If they're not providing any value to you already, then why do you invest in them? But everybody has their own opinions on things. Let me know what your opinion is. I'd love to hear it. Thanks for watching the video.